In this video, I'll be teaching you about the top 5 things that I wish I knew when I first started on my investing journey. Investing is a great way to build your personal wealth and generate a consistent stream of income. You might have some spare money lying around that you're wanting to do something with, and you may have heard of people becoming millionaires from investing in companies like Tesla and Facebook, and you want to get in on the investing action and start making some money of your own. But you might be worried about the potential risks that come with investing, or thinking that you're going to lose all your money. This is really a great beginner video that is really useful for anyone who wants to get started on their investing journey. I'll be clearing up some of these misconceptions and some common mistakes that do come with investing. Next is that you have to be the best stock picker. People think that you have to be the best at picking individual companies, spending hours upon hours looking over financial reports, understanding all the little ins and outs of a company, but really you don't. You can bypass all of this by just investing in the whole market itself as opposed to an individual business. So how do you do that? The best way to do that is by investing into an ETF that tracks the broad stock market index. The best one for this is either the Vanguard or iShares ETF that follows the S&P 500. So just to give you a bit of context, an ETF is an exchange traded fund. This is just basically an investment vehicle that has a particular goal, like it will track a specific commodity or a currency or the overall performance of a country's stock market. So with the S&P 500, that is the top 500 companies in America, and then with the Vanguard and iShares ETF, its purpose is just to mimic the performance of the S&P 500. So it'll buy into all the same companies, it'll have the exact same performance if you put the stock charts side by side, and this is a very safe, consistent and reliable investment because your money is not just restricted to one business. When you put your money in that S&P 500 ETF, then your investment is spread out amongst companies like Facebook, Google, Amazon, Tesla, Coca-Cola, all these well-branded, well-recognized companies that have stood the test of time, and really they're not going anywhere. It's one of the easiest ways to make your investment nice and safe, and once you put your money in there, you don't have to worry about it. You can just never look at your portfolio ever again. You don't have to worry about what the exchange rates are doing, what is the newest, fastest growing business, anything like that. It's the most tried and true investment that has withstood multiple market crashes and multiple corrections, but for better or for worse, it's still grown at a very consistent rate of 8 to 10% every year. So that's the kind of return that you can expect to make with this investment, and it's really a great strategy for anyone, regardless if you're advanced, beginner, no matter what. Investing is largely a long-term commitment. You don't need to constantly be checking the stock price of a business you've bought into on your phone, seeing if it's gone up or down, if you've made a profit, if you've lost a few percentage points. It's about how much money you can generate over a period of years. You're not looking to make a quick buck in, say, 1 month or 3 months or anything like that. It's a 5 to 10 year commitment. The business you have shouldn't be so volatile to the point where it can rise 30% in just a few days and then drop by 50% the following week. Unless you're investing in something like penny stocks or Forex, then it's more of a constant commitment to always be checking the price of your investment because of how quickly they fluctuate. But if you're buying into regular blue chip companies like those found on the S&P 500, they're a lot more consistent and they're not subject to such volatile changes, and there's no need to always be looking at your phone and seeing what your investments are doing. You really don't need to check them if you've put in the research and the time to understand the business and be confident where your money's going. It's only really when you don't understand the business that you find yourself always looking at the stock chart for that company, because you're worried that it could drop or that the price might change and you'll lose all your income because you don't know what is really influencing that business. You don't understand its cash flows, its debt levels, all these significant things that are really the fundamentals of a company and the things that really dictate what happens to the stock price. Fluctuations are completely normal and it's inevitable with every company. The stock chart doesn't just grow in one nice straight line. Understanding that there's dips along the way is just a completely normal part of investing. Moving on to knowing the difference between speculating and understanding an investment. When you speculate, you just make assumptions on what the stock price of a business is going to do based upon little to no factual information. For example, someone might tell you this stock is going to go crazy, it's going to go up 50% in the next few months, and then you just buy into that business purely based upon what someone else said. Or you might recognize the CEO of a company, or you might really like the brand of a particular business, and then you just invest in it. You might personally own a car made by Ford, or you might really like Nike running apparel or Apple's iPhone, and then you just invest in these businesses because you like the products that they make, versus actually understanding the business and judging it on sound investment principles like its cash flow, its management team, the amount of debt that it has. These are the true factors that dictate the stock price of a business. And knowing these fundamentals of a company is where you're going to get a really good investment from, because a stock is not a lottery ticket. The stock price is tied to a business. If the business is doing well, so will the stock. So if you want to understand a company, you really want to be looking at its financial reports, and it will give you an exact explanation of how that business operates, how it makes money, what factors can hurt its income as well. If you want to find these financial reports, go over to the company you're wanting to look at and go over to the SEC filings, and you'll see a large document called a 10K. And this is a document that's printed on an annual basis that completely outlines all the ins and outs of a business, so you can have a very, very good understanding. If you just want a basic understanding, you don't have to read the entire thing. It's quite a commitment, and ideally you'd want to be reading several of these, say over a period of years, so you can see how the business is changing. But if you just want to have a quick understanding how that business works, how it operates, just having a look at the risk factors, looking at the sections that outline how the business makes its money, and then you can look at these trends and if these factors are growing. And that should be the things that influence your buying and selling decisions, not media perception or what other people say or what your own personal feelings tell you about a business. It needs to be on factual, accurate data. I'll leave a link down below in the description to the Facebook 10K if you want to have a closer look at it for yourself and start to build your knowledge on the business. And virtually all well-recognized sort of blue chip businesses have a 10K report. Ones that are a bit smaller, maybe if you're investing in companies like Australia and New Zealand, they might not have a full 10K report, but they're still quite lengthy documents on the investor relations page that give you information about these slightly smaller businesses as well. Moving on is thinking that you have to make investments quickly. You don't have to be influenced by other people's buying and selling decisions, getting caught up in FOMO, just buying into a business because other people are. You can take your time spending several months or even a year researching a business before you buy into it. If you don't have a sound understanding of a business and its principles and its financials, you don't have to buy it. Don't rush into investment just because you see that other people are. Often this is the easiest way to get burned, because if you buy a business just because it's rising, you might get in on some of these profits and you'll get some money along the way. Often if a business is just rising exponentially with no fundamental reason for it, then it's gonna ultimately backfire on you in the end. GameStop and other meme stocks that came about recently, people would have gotten in on the ride when it was rising in value and made a fortune, but others would have been badly burned. You don't know if you're going to buy here, here, or here. You don't know when it will drop, when it will rise, and it did go back up in value, but now you don't know if it's going to keep going up or it might just drop straight back down because it just went up on hype. And this is relevant for any stock now and for all of those in the future as well. I will say it is hard to not be enticed by the ever-growing stock price of a business, even if it is just a hype sort of thing. But if you do want to invest in a company like this, I would say you need to set aside a sum of money that you are completely happy with losing. You're essentially just gambling with that money, so once you put it into that company, you need to be entirely happy that it could all just disappear on you. Also, setting yourself a limit on how much profit you want to make. If it goes up 30%, take that money and then sell the stock and secure your profits. Next is taking notice of brokerage fees. People often overlook this when they first start investing. They don't think how this fee can add up over time and ultimately eat away at their portfolio. Now, brokerage fees are typically expressed as a percentage or a flat charge. So if the broker that you're using charges a $5 fee for making an investment and a $5 fee for selling your investment, that's a total of $10. So if you invested $100 and then there's $10 in fees, that means overall you'd have to make 10% just to break even on that money. You can see how this adds up over time. If you're constantly adding in, say, $100 each week, then by the end of the month you've invested $400, and then you have to make $40 from your overall portfolio, which is far too spread out as well. You don't want to have $100 each spread out amongst 4 different companies. You're better off getting total $400 you've set aside in the month and buying into one business once. So you put $400 into that company with one brokerage fee of $5, and it's a far more efficient way to do it than constantly swapping out between different companies and investing every week. Also, looking at the exchange rates when you're making your investments. If you're not from America and you're buying to the US stock market, there will often be an exchange fee. So if you're in New Zealand or Australia, Stake is often one of the most common brokers because there's no fee for making an investment, but there is a 1% exchange fee. So do factor that in when you're looking at using your money on the platform. So if you had $1,000 to invest, you're going to have a 1% fee. So that's going to be $10. So you're left with $990 to invest and no brokerage charges. It can often be the easiest way to cut down your costs and avoid always running into these brokerage fees all the time. And if you're a long-term investor, you're not really worried about this because you don't move your money in and out of companies all the time. But if you're someone that likes day trading, only holding businesses for very short periods of time, you're going to need a broker that does not charge a brokerage fee. Otherwise, your portfolio is going to get eaten away by the brokerage charges. Number 5 is only looking at the stock price. When beginners first start investing, the only form of analysis that they often do on a company is just looking at the stock price, seeing if it's gone up, if it's gone down, how well it did in the past, thinking that the previous stock price performance will automatically reflect what will happen in the future, thinking that last year that business went up 30%, it's going to do the same this year, or oh, it's already gone up 50% this year, it has to crash. Looking at businesses like that is nowhere near a borderline analysis to determine if that's actually a good investment to put your money into. This is a huge thing for beginner investors, not understanding that there's far more to a company than just its stock price. Lastly is reading a very, very important financial book that isn't specifically related to investing, but it's great for understanding money as a whole. And it's called Rich Dad, Poor Dad, because when people start investing, it's with the goal of increasing their personal wealth and making more money. But there's other avenues to make money as opposed to just investing, and being able to understand money and how it works and how to generate more of it isn't just restricted to understanding the stock market. The knowledge basis that this book provides is a great stepping stone to lead you in other directions of making more money for yourself, and it really helps with losing that emotional attachment to money, which is critical to being a good investor. If you get angry when you lose money on investment, or just get caught up in FOMO or hype and let emotion be a strong influence on your buying and selling decisions with your investments, it's a really, really great way to have the stock market be a frustrating time. So this book is great for getting that under control and looking at other avenues to make money, investing in property, building a business, changing your whole outlook on how you perceive money, what it's used for, and how you can generate it for yourself. So this is really something that leads you into other avenues than just the stock market, and this is a book that I'd highly recommend for anyone who wants to improve their finances. Now that you're familiar with some common investing mistakes, where is a good place to actually put your money? The video on screen will teach you one of the greatest investments that you can make. Click that video to find out how you can generate an easy, reliable, and consistent stream of passive income with one of the most straightforward investments.